We're going to talk about expectancy. I know a lot of you have heard about expectancy. I know a lot of you have heard me talk about win-loss ratio, percentages, so on and so forth. But this is paramount to understand and then use for you, the benefit of you, because whilst everybody has to have a positive expectancy to be a successful trader, there's different sections of expectancy that suit you, not necessarily me, but suit you. And what we're also going to talk about here is you as traders and how you want to trade and how you want to make money, not necessarily how I want to make money. And I think it's very important. You go to certain seminars and you'll get preached to, this is the only way to do it. You have to be a trend follower. You have to trade on a 5-minute chart. You have to use the CCI. I mean, that's just garbage. What I'm going to show you here, what we have to do is ensure you're managing your risk, ensure you're getting a positive expectancy, but also ensure that your trading suits you. Some of you here will want to trade for an income. Is there anyone here who wants to trade for an income? Okay? But there's others here that have professional jobs, want to stay with those jobs, but be involved in the market. Okay? Two very, very different things. So if you go, for example, and do a seminar where you're being told the only way to trade is trend following. But if you want to trade for an income, you can't trade using a trend following method because you're swinging for the fences. It may take 6 months for you to pull a big winner out of the air. And if you're trading for an income, you can't wait 6 months. You've got to be able to chip away, chip away, chip away, put the money in the bank, that kind of stuff. So I'm going to show you how to do that. And therefore, if you have another job and you want to just have something going in the background, we use a trend following method. But if you want to focus full-time on trading, then you've got to be able to do that as well. And that's a completely different strategy. So I'm going to show you all that kind of stuff. But first, the foundations is expectancy. It's important to understand expectancy and how it relates to you and what goals you want to do. And belief in expectancy is really what it's all about. I use a term all the time, why are you profitable? Why is this system profitable? John hears me talk about this all the time. It just goes over the top of people's head. I say to people, but why are you profitable? Well, if the moving average crosses over here and the divergence is there and this happens there, I'll be profitable. Well, that's just garbage. Okay? You put 250 people in a room, 250 people are doing different things, but they're all profitable. It's because they all are achieving positive expectancy. And that's why people make money. Soros makes money. He's a macro investor. And you go all the way down to your guys on the trading floor of the Steam Futures Exchange or the CBOE, whatever, and they're in and out, on the bid, on the offer, in and out. All they're doing is creating a positive expectancy, and that's all we want to do. Everybody is totally different. You've seen this chart before in my book. In fact, this has appeared in some major US websites in recent times without my permission because they feel that it sums it up exactly. And now that they have my permission, they can continue to use it. But every single person, regardless of what course you go to, what seminar you do, what you believe, you will appear somewhere on here. But what I'm going to tell you today is that your personality will dictate, and your goals, your trading goals will dictate where on here you have to appear, and therefore where you have to work at to do that. For example, if you're wanting to work for an income, you've got to be further to the right-hand side of this chart, okay? But if you're happy to swing for the fences and you've got other income in the background to support you, a job, whatever it may be, well, you want to be to the further to the left-hand side of the chart. So if you go to a seminar thinking, well, I want to swing for the fences, but they're teaching you what to do on the right-hand side of the chart, it's not going to suit you. And therefore, you're not going to be able to do it. Very important to create the expectancy curve that suits you and understand. The only way you can do that is understand how it impacts on you. So this is a simplistic view and you will appear on here somewhere. I've put there the normal operating area of where most people will operate, but ideally you've got to be above that curve somewhere, and the further you're above that curve, the better off you're going to be. The foundations that we base our trading on come down to personality, risk tolerance, your objectives, your time, all these different things. They're all important. We all drive different cars for very, very different reasons. You know, Trish and I just have what we call a silver bullet, which is like a $5,000 little hatchback. It's just a zip around that does its job. It's no big trips, but it's there to do its little job. So we have that car for that particular purpose. But, you know, the guy down the road has a nice Bentley, whatever else. Well, he's got that for his purpose, okay? Different things, and everyone is different. So it's important you find what's right for you, not for me. So what we want to look at is expectancy. This is the rule formula, and you can derive this from your own trading. You'll know if you've got a positive expectancy or not, because your account will either be in the black or it'll be in the red. If it's in the black, you have a positive expectancy. But also when you're testing a trading system or a style or whatever else, you can calculate what your expectancy is. What I want to get across to you today, though, is that you can trade and create your own expectancy. But you have to understand how to create it first. And once you fully understand how to create your own positive expectancy, you will look upon trading in a very, very different light. You will see immediately and become skeptical immediately of certain people's thoughts and processes, what they're trying to sell you, and you'll know exactly what's right and what's wrong and how to make money from the market by understanding this expectancy. It's a very simple equation there. The probability of winning is your winning percentage, your average win, and you subtract your probability of losing and your average loss. I had a phone call a couple of weeks ago. This gentleman, it was the second time he'd called me. He said, I spoke to you the other day, I'm thinking of subscribing to your service, but I just want to make sure I'm not going to get ripped off. I said, righto, mate. And he said he had been subscribed to another service, we won't mention that particular one, and he had been sucked in again. Right, so you've been sucked in, and he said, you know, they're just really dodgy, I should sue them. 4 out of every 10 recommendations they made were losers. I mean, you know, they were ripping me off. I'm going to sue them. I said, well, you know, if it's a proper service, which it was, they're fully licensed by ASIC, and you can go right ahead. If you think you've been ripped off, you can sue them. Oh, I don't know, maybe I shouldn't sue them, but you know, they're pretty crap. They're only getting 4 out of 10 recommendations right. And I said, well, you know, there's nothing wrong with that. And this guy simply did not understand what it takes to be profitable. And this is what I want to get across to you. I know it's simple. You might realize this is quite simple. But this is what it's all about. It's about understanding why your system will make money. And it has nothing to do with the indicators or whatever else you're doing there. So let's look at a casino. The way it works at a casino, and this is specifically roulette, is the casino will always win eventually. Okay? If you go and play roulette, you will, in fact, eventually lose 5% of your money. Or the casino will make 5% of every dollar that gets put through their casinos. So that's using from a roulette, and that's why the big Las Vegas casinos are some of the wealthiest companies in the world. They have a positive edge, and their goal is to simply exploit that edge as much as they can. Have you ever wondered why you've gone into a casino? It doesn't happen so much here in Australia, and grog's free, food's free, great shows on, pure oxygen pumped into the air. Yep. Have you ever wondered why? Their goal is to make you play the game. So they suck you in with free alcohol, wonderful shows, free food, everything. So long as you're in there playing the game, they will make money. And they will make a lot more They will make a lot more money. The more people go in there and play, and that's why they're open 24/7. We'll show a few other little tidbits on casinos a little bit. So if we look at the growth portfolio, and all I've done here, I'm not trying to sell the growth portfolio because this is a trend following model. Your goal is to find something that suits you. But what I thought is many of you, or most of you, are subscribers to the service, and you might be aware of the growth portfolio. So I thought I'd use real numbers. That's the whole idea, just use real numbers. This has been running for about 15 months. We've made about 60-odd trades in that particular time. But you can see here the winning percentage is 50%. Now, according to this knucklehead that called me the other day, I am dodgy and I am going to be sued. But you can see what happens here is the average trade I win 25.5% return on the money, and the average losing trade, the average winning trade 25.5%, the average losing trade is 6.75%. So it's not how often I win, it's how much I win when I win and how much you lose when you lose. Now here's the crux. The only thing you can control is how much you can lose. You cannot control anything else. The market will give you whatever the market's prepared to give you. Obviously, different market stages you will get more. The last 5 or 6 years, you got a lot out of the market. The market's giving you a lot. So all you had to do is just cut your losses, limit your losses, which is the only thing you can do. And when the bigger trade comes along, you just ride it for everything that it's got. Now, the market will change personalities over different times. The last 6 years have been exceptional. I can guarantee that we're going to come into a very difficult stage eventually, and it's not going to be as easy as it has been. But ultimately, this theory will always remain in place. It will never change, regardless of what the market is doing. What you have to understand is what the market is giving you at any particular time will change. Sometimes it'll be very good, other times it won't be so good, but you've got to stay with it. One of the biggest lessons, a lot of my, ever since I've been teaching, I think was presented in 2002 when we went into the bear market. When I was at Macquarie Bank, we used to run this system, and pretty well every single client stopped trading it. And some are still waiting to get on. And they've missed some of the greatest moves we've seen in our generation. We really have. You see Paladin at 30 cents back then, and you think, God, how did I miss that? But this is what's happening. Now, I know that some people are missing out on this current strength we're seeing in the market. I'm fully invested. I didn't stop trading this system when August came along. Stayed in there. Followed the rules. My account's at new equity highs. That's all you've got to do. So what you've got to do is remember that the positive expectancy will always win eventually. It's going to go through some rough trots, but eventually it will win. It's like the journey. I use this analogy a lot, travelling from Sydney to Brisbane. You're going to run into roadblocks. You're going to get a traffic jam. You're going to get a red light. You might get lost. You need a toilet break. You might get tired and think, okay, I'll have to spend the night over and I'll travel again tomorrow. Eventually, you'll make it to your destination. But with trading, for some unknown reason, people get lost in that transition, which means they don't understand how expectancy works. They do not understand how profits get generated. And we'll look at that a little bit later. So here you can see very simple methodology. All we're doing is catching a trend. If we're wrong, we're getting out. If we're right, we'll stay with it until the trend completes. Every so often we'll get lucky. We'll get on a ripper of a stock. And that's what I mean by swinging for the fences. Eventually we'll get one that just keeps on going and keeps on going. The worst thing you can do is stop the ride. And that's what people do. They tend to stop the ride thinking, oh, I'll bank that money, I'll bank that money. And that comes back to what I said before about you trading for income, that is needing to chip away and bank the money, or swinging for the fences, capturing those big, big trends. Here's the Growth Plus. Here we're making $2,482 for every $10,000 invested. So we've got an expectancy of over 24, almost 25%. Now this one has a win rate of just 38%. So this is where people psychologically get caught up in this, you'll win 80% of the time, you'll win 80% of the time. And the hard truth is, to be successful in trading, it's not about how often you win or how often you lose. That's the stuff we learn at school. Successful trading is how much you win when you win and how much you lose when you lose. The turtles, the most profitable traders in the world. Curtis Faith, who just wrote that recent book called Way the Turtle, you know, he pulled $30 million. But their win rate is like 32%. So when he got on one that was winning, he just rode it and rode it and rode it. When he got on a loser, he was out. He was out, out, out. But psychologically, people want to be right more often than wrong. That's the way we're brought up. If you can get over that and think about, well, if I place a trade and I win $5 when I'm right, and if I'm wrong I lose $1, you will always be a profitable trader. The easiest way to do that is by trend following, but it's by no means the only way. If someone comes to me and said, Nick, I've been trading for 10 years, I just can't make money. The way I push them is towards a trend following model. End of day, don't look at it, just follow the longer term trends and eventually they'll get there. That's the easiest way to make money, but it's not the only way. But the concept of trend following comes down to a 1 minute chart. This growth and growth plus portfolios, you can actually use them on 1 minute charts. They work perfectly well because the principle of why they're making money holds true. It's cutting a loss and letting the winner run, even though we're running it on a 1 minute chart. You're going to tell me trends don't occur on a 1 minute chart? There's some beauty trends on 1 minute charts. Can you be bothered sitting there all day and trading it? No, but the same principle applies, which is why I always say, why does your system make money? That's why.